good morning, and thank you all for taking the time to join us for the Q2 Binary Capital webinar. Really pleased to see that all of today's speakers have turned up in the Binary Blue, which is great to see. Obviously, I might be a new face for some of the existing clients of Binary Capital. I've recently joined the business development team working alongside Saab and Sam, but I've actually been in the industry for quite a while. So the last 14 years, I've been working with IFAs and paraplanners, initially helping with fund research at FE and Morningstar, before spending the last 7 years focusing on managed portfolios and building strategic partnerships with firms all across the UK. So it's been a great start for the last 3 months and really excited to be on this journey with you all. So looking at today's webinar, the new norm or more of the same. I think we can all agree that 2025 has presented a challenging landscape so far for investors. High equity valuations, geopolitical risk, and renewed US tariffs have all led to more volatility. So today we will spend some time reviewing if this will shape markets for the long term and how our portfolios are positioned to produce positive client outcomes. So Saft has very kindly shared the agenda, so feel free to take a look. But if I can just quickly run that through with you all. Obviously, we're delighted today to have the combination of existing clients, for partnership firms and firms who don't currently work with us. So initially, I'll start out by giving an introduction to Binary Capital and touching on our performance. Our CIO, Safdar Sarwar, will then spend some time providing a macro update. He will show you our conviction update following the recent market movements and discuss alternatives in our portfolio and the role they play throughout a market cycle. And finally, Binary Capital carried out some IFA research at the beginning of the year, and our head of sales, Saab Thind, will be sharing these insights with you and also highlighting the importance of producing personalised literature and insights for both you and your clients to help them make informed decisions and stay in the market. You'll also see there's a little segment there for the Q&A. So just want to take a bit of time now to point out that if it's not already prominent on your screens, right at the very top where it says more with 3 dots, that should give you a Q&A button if you can't already see it. The great thing about that is it allows you to anonymously submit your questions, and we'd really encourage you to do that throughout the sessions. Safdar, Saab, myself, we're happy to address any questions through anything that's covered off in today's presentation. So now I just want to talk a bit more around Binary Capital. So Binary Capital was launched in 2018, and then looking on to 2019, that's when we first launched our UK managed portfolios. So we have a whole suite of portfolios that aim to help your clients achieve their goals. So we have our off-the-shelf range. This includes our active, passive, and core range. And those particular clients need something a bit more specific. We also have tailored portfolios that includes defined returns, investment trust portfolios, and more recently, gilt portfolios. One thing I want to point out about Binary Capital and our portfolios is they're fully independent. So what this means is that our portfolios don't feature our own funds. Safdar and the investment team have access to the full investment market, all global markets, and there's no bias when it comes to making investment decisions. On top of that, the relationship is very much with IFAs, so your clients can't invest with us directly. We'll only liaise with you, the IFA, and never directly with the end investor. When it comes to our approach, I think there's 2 key elements to it. First thing is it's long term, and secondly, it's high conviction. So we're not looking just to make a series of short-term wins. We're very much looking at long term when we're building portfolios. And when we come on to my next slide, we think we can back that up with our performance. Of course, when we're looking at our particular portfolios, obviously, when we look at our peers, they have a lot of portfolios that feature a lot of funds, looking at 25 to 30. And we think it's very difficult to make high conviction plays and allocate the right proportion to your bigger areas that you want to invest in when you have too many funds. So when you're looking at Binary, we tend to focus on the 10 to 15 funds, and as you'll see here from this slide, performance has been strong. But if we just go back a slide for a moment, I just want to touch on the platforms that we're on. So we're looking at 14 platforms at the moment. It is a little bit small on this slide, but what I will say is that Saab and myself will be following up in the coming days. So if your particular platform isn't on there, then please get in touch and we'll speak to them. But we'd like to think we're working now with the majority of UK major platforms, and we're in talks with more to extend the coverage. Now, I appreciate if you're an IFA or a paraplanner, You probably also want to do your own research. So it's important that we work with a lot of data service providers. So both of my former companies, Morningstar and FE, feature in that list. With FE, if you've got a license, please feel free to request access to our portfolios. If you're not an existing client of ours, we will let you have a couple of weeks to run your analysis against your existing proposition or your in-house models. That's no problem. And also for due diligence, we've got Defaqto and DD Hub there for you to carry out your own analysis. One thing I want to point out, a bit of an exclusive for today, is that we'll also be adding another partner in that space, and that's Mabel Insights. Now, if you know Mabel Insights already, great. If not, it is a research tool allowing IFAs to conduct research of their own in-house portfolios or their chosen DFM versus the leading DFMs in the market. And we're very, very pleased that we'll be joining this software in the coming weeks. We're actually hoping it might be live by the end of this week, if not early next week. And what I'd encourage you to do is, if you want to leave the word Mabel in the chat, we'll let you know when this goes live, or alternatively, we'll drop you all a link next week with all the details. The important thing for you guys as IFAs is that Mabel is a free piece of software. We think it's important. We want as many IFAs to be seeing our data as possible. So Mabel, there's no license fee required. And again, it's all web-based. And they'll also be joining us on our upcoming roadshows if you want to meet the team in person. We'll share more details of that at the end. Just before I pass on to Safdar, I think it's important to talk about performance. You're probably wondering, why it's included at this stage of the presentation. But I think it's important to look at it in all market conditions and not just when the outlook is positive for investors. We've been speaking to a lot of IFAs recently, and it is something that we know that you're getting questioned on. And we feel like it's a good chance to speak about it. Obviously, we've got some very strong returns here. And it doesn't just display outperformance against the IA sectors, but also that the risk profiles are aligned with their respective risk and return profiles over that 3 and 5 year periods. So just looking at a bit more detail here, on the right hand side, the 3-year returns, that's looking at our passive portfolio. We made a fundamental change to our approach 3 years ago for the passive portfolios, and that's paid off massively. So not just this chart here, but when we're looking at the Morningstar DFM peer group, I'm really pleased to say that we're actually in the top 5 percentile for performance for passive portfolios. When you combine that with the fact there's only 5 basis points, our management fee for that range, we think it's a very compelling proposition. And we'd be very happy to speak to you if that's of interest. Moving across the left, another one of our off-the-shelf solutions. This is our core range. It's a blended proposition, so it's passive and active combined. This is 5 years, again, demonstrating that we're not just saying we do it for the long term. We can actually back it up with some figures. And again, through a massive market cycle, we've seen some very challenging markets, but Binary has still been able to compete at the very top level. So yeah, as I said, you've got all the options there to go and do your own research, but it's very easy for our investment team to produce our own performance packs. So if there's anything you want a bit more specific or look at certain time periods, please do get in touch, or alternatively, we'll be in contact in the next couple of days. So obviously a big thanks for letting me speak this morning. So I just wanted to very quickly introduce Safdar, who's our CIO. He's been with the team since the company launched. He's got 25 years of industry experience with a real focus on equity markets. And those of you who are prominent on LinkedIn and social media, you'll have seen that Safdar regularly features in the likes of Citywire, Professional Advisor and Asset TV. And I'm delighted that he's going to spend some time today talking about the markets and, in particular, alternatives and what we're likely to see in the coming months and years. So over to you, Safdar.
Thanks for that, Tom. And good morning, everybody, on this sunny morning. I'm not Sam Boughton, as you can see, maybe in the prefix of this thing. I'm just on Sam's PC. But yeah, thanks for that, Tom, that kind of initial summary overview. What I'm going to do now, if I may, for the next kind of 20 minutes, 25 minutes, really cover off this year so far. We're kind of nearly half the year in, give or take a month. And it's been very, very interesting from an economic point of view, politically, as well as clearly financial markets. It's been a bit of a roller coaster ride this year. And then at the same time, touch on how we see things for the rest of the year and perhaps into 2026 as well. Clearly, there's a lot happening. There's a lot of uncertainty, and hopefully give you some colour on why we see things developing until December and how as well. So I'll cover that for 20 minutes or so before I hand across to Sarb. And as the guys said, feel free to ask questions, whether it's now through the chat function or whatever. Happy to take questions as I go through as well, completely. So moving on, I've got quite a lot of slides to go through, so I might rush through them from time to time, and I can always refer back to them in any Q&A at the end if one needs to do so. So moving on to this slide, clearly, as I said, there's a lot happened this year. Some people have kind of likened it to what happened in the 1970s with Bretton Woods and the dollar coming off the gold standard into a kind of floating exchange rate mechanism. And thereafter, there was strong implications around currencies, inflation, depression or pure economic growth, and so on during the 70s, stagflation and so on as well. I don't think it's an exact comparison, but certainly it's interesting to see some of those alignments that we've seen even this year with clearly the main news around tariff. And I'll talk about that in a minute. But I want to touch on the start of the year. We've had kind of two halves so far for the first kind of 5 months or so. First 6 weeks, very bullish sentiment, US equities, global growth. The narrative was very much around American exceptionalism in terms of leadership of corporates, as well as economic growth in the kind of 2 to 2.5% or so. And then thereafter, come mid-Feb or so, things changed radically with President Trump's announcements with Bessent and Lutnick around tariffs and the high level of tariffs that they initially envisaged doing for markets, for economies across the world. And thereafter, as we know, the markets are very much full of animal spirits and crowd behaviour, and told them and us that it wasn't accepted, and there's strong sell-off in markets more or less across the world. A lot of correlated assets sold off. The only real asset that didn't do so was gold during that period, even up until now. So strong sell-off. And then we had Liberation Day in early April when the actual tariffs took hold. The different range of tariffs, whether it's 10%, 20%, as high as 100+% in China, and Chinese goods and so on coming into the US. So that was interesting conceptually. But then since April, what we've seen is really a change of mood. Firstly, a change of mood, and at the same time, a change of sentiment as well, and an actual reality with Trump and his team putting pause in tariffs as they negotiate down to more equitable levels. We saw that more recently with respect to the UK trade agreement, as well, and then the pause in tariffs just last week with China and renegotiating their kind of high levels there. And so that's interesting, clearly, in terms of pragmatism as well. So the point we're making here is there's a lot of movement where it's like tariffs, permanent changes there. Trump and his team are quite happy to have a weaker dollar to mitigate any concerns around global growth that they have themselves. Clearly, there seems to be a lot of movement around supply chains going forward, and one needs to take that into account, where that's a short-term shift, a more secular that I've referred to earlier. And we've had growth scares, we've had economic issues, we've had potential US recession outcomes coming out from moving from a 20% base case to maybe majority level and so on. And at the same time, investors are now really concerned about valuations. Previously at the start of the year, investors came in saying, US equities were highly valued, but they were prepared to pay for that. But subsequently, valuations are becoming very, very sensitive to the extent there's been a strong pivot or movement towards more value type equities. For example, European stocks, defence stocks, even the UK has participated in that rally as well over time. And hence the reason we make the point about perhaps value equities now being a key figure of interest going forward as well. There's other points here I don't want to dwell on too much, and I'll go on to them in subsequent slides, but certainly there's some interesting dynamics at play that we have been aware of up until now, and perhaps we need to be more aware of going forward as well for the next 5 or 6 months or so. I want to touch on the politics because it's actually even relevant this morning. There's been an announcement by Trump on Truth Social that they've come to some sort of agreement with Ukraine, Russia, that they've got to kind of knock their heads together and start negotiating a kind of peace settlement, and he's now going to back off from that. And it was quite a positive statement that he made, and he's quite keen to open up normalization trade links with Russia. But clearly, as you can see here from this slide, there's a lot going on. You've got Russia, Ukraine. You've got obviously the Middle Eastern as a powder keg, as it always has been, but clearly has been more relevant over the last 2 years or so. More recently in Southeast Asia, we've had potential conflict as well that's been stabilised somewhat over the last kind of week or so. And clearly, China, Taiwan is always a situation that's there in the background and pops up regularly as well. So from a geopolitical lens, if nothing else, there's a lot going on that certainly US is trying to show leadership in and direction in. Otherwise, who else can do so? But clearly, from a kind of more of a kind of laissez-faire, backing off and not getting involved, boots on the ground, or support in the broader sense of the world. Clearly, one of the reasons that Trump wanted to minimise the Ukraine-Russian conflict was the fact that America was funding so much for that conflict, and clearly that's not in their economic interest potentially to do so. We saw last week Trump's visit to the Middle East, clearly for many reasons economically, big announcements made, $100 billion here, $1 trillion, whether it's Qatar, Abu Dhabi, and clearly Saudi Arabia and so on. So that was interesting conceptually. At the same time, what was also interesting was he already had a meeting with al-Shara of Syria, the gentleman that's taken power effectively from the previous regime, from Assad regime. But that was interesting conceptually because Trump's saying that he wants to normalise relations with Syria. He's moved sanctions from Syria, and you got to remember going back even last year, this guy had a $10 million bounty on his head for capture. He was actually captured by the US authorities roughly 10 years ago and held in prison for 6 years, fighting against the US. So as they say, life comes at you fast sometimes as well. So again, a sign of pragmatism by Trump, a sign of, it's not our problem. We want to make friends with people and stop conflicts as much as one can do so. And even in Israel, Gaza, he's trying to be supportive as much as one can be so in that long-lasting conflict that's gone for many decades there. So certainly geopolitics, but we think there's elements of calmness arising that should benefit markets going forward. We put the slide in about the yield curve. There's been a lot of movement in the yield curve, clearly around inflation concerns. I talked earlier about tariffs. There's a debate around stagflation, for tariffs and how will that impact on inflationary outcomes going forward this year, and interest rate outcomes as well. And policymakers have been highlighting the point around the fact, look, we've got inflation. It seems to be persistent, albeit the recent numbers have been fairly benign. So we need to be a bit more cautious if and so we do drop interest rates going forward. And certainly some of those movements have got further down the year or months this year, as opposed to more recent trends. Hence the reason we've had, certainly here in the UK, the yield curve picking up, certainly at the short end, more recently, and certainly more so on the longer end as well, as the market's implying, maybe higher interest rates, and therefore you want higher bond yields to compensate for that as well. So again, something to bear in mind, that we've not just had volatility in equity markets. There's been strong, very volatile bond markets as well. As I said, not much areas to hide over the last 5 months or so. I touched on US equity valuations being high. Despite some of the sell-offs we seen more recently, they still remain high against its own kind of average over the last kind of 40 years or so. And other equity markets certainly below average there, so room for growth, certainly on that kind of bar chart that you can see. And then the other chart, the line chart, shows you the relative discount of other equity markets, whether it's China, Europe, and even the UK against the US. Then, as you can even see in 2022 to even more recently 2025, while that discount somewhat has narrowed, it's still quite deep. In the UK, you've got as much as a kind of 30% discount to US equities. China even more so as well. So one can argue that either the US is too expensive, or certainly some of these equity markets are very, very cheap and should be certainly looked at from an investment point of view on its own isolation, never mind anything else that's going on. This trend has been going on for a while, as you can see from the chart. But the point here is they may well have been a pivot point in the context of tariffs and some of the policy announcements that we've seen at the start of this year. To be all confirmed, but certainly it's something to bear in mind as we go through the rest of this year as well. This chart really kind of highlights the fact it's not all about equity returns. There's been a strong movement in the currency markets. US dollar has sold off considerably over the last 6 months, almost like a 10-cent sell-off from 122 or so, 121 to 130 or so, 130s, mid-30s now against sterling. So a strong sell-off in the US dollar, implying weakness. So therefore, if you hadn't, as a sterling investor, if you hadn't hedged, you would be suffering losses, or it would be going against you. Something that we are very, very cognizant of and aware of as we invest for clients around making sure, if we can do so, if we have a position to do so, and there's valid reasons, we will hedge out our large position, or certainly partly hedge out. So therefore, our return outcome, we want to really take effect or run through our equity returns as opposed to any currency movements or so. And these kind of phenomena could be more so going forward as well in terms of currency movements. As I said, the US is very relaxed about some of its weakness that they're seeing in the dollar more so, and it's not been supportive at all. That may well change, but again, something to bear in mind as well. From a currency perspective, and as I said here in this chart, from an investment perspective as well, look at the difference between the hedged share class of this return against a non-hedged share class as well for sterling investors. You've not actually not made any return, or you're in negative territory if you didn't hedge out the currency exposure there. This chart, very common chart, again, very popularly kind of announced. What does it tell us? It tells us that we have drawdowns. Drawdowns happen in markets very regularly, being an example here in the US. But these drawdowns can be often sharp, can be very time limited. And again, it pays to be invested often throughout this, because timings can be very, very difficult, typically, to manage through these drawdowns. One clear example being even this year, in April, just last month, we had a circa -10, -12% drawdown up until mid-April. But once we started seeing that there was pragmatism involved in some of these discussions, and Liberation Day could have been seen as a negotiating tactic, and there was elements of pragmatism and discussions going on, and even trade deals taking effect, or discussions around that, the market, certainly the US market, rose sharply to the extent now Nasdaq was up 10-15% in the second half of April, and the US market overall, S&P Dow Jones, was more or less flat during that period. And now Nasdaq year to date is only about off 4% off its all-time highs, just above 20,000. So again, it's very, very hard to time this. Something that we at Binary Capital were thinking about quite radically during March and even April. Do we pivot away from some of the things that I've just talked about, whether it's US equities, into other more safer asset classes or whatever? If so, how do we do that, and so on? But we decided to not really make any changes whatsoever and wait and see. So far, that has proven to be the correct decision based on the vol that we saw. Based on we don't have any material confidence or competitive advantage on timing. So why should we try and do that? It would have been very hard in April to have done that. So it's best to fundamentally, as this chart demonstrates, throughout history, throughout the last 20 years, and you can go back even longer, it's better to remain invested in the markets for the long term, manage the drawdowns if one can do so as effectively as possible. And I'll touch on that in a second. But beyond that, be patient in your investment outlook. Forget us doing so at Binary Capital. The best investors in the world do so, and you should be doing that anyway, whether it's with your own investment portfolios or certainly with any partners that you're working with now. In terms of patient capital, long-term investing makes a lot of sense and is validated by this chart and has been validated by other data points throughout history, and there's no reason that will change going forward. How are we positioned in terms of our allocations and various assets? Kind of high-level overview. We're neutral on the US based on some of the previous comments about valuation trends and whatever, and we're actually overweight or more bullish on the EU and the UK, and we have been so for a while now. For the last kind of 12 months or so, we've been gradually moving into that kind of trend, and that's proven to be obviously beneficial for us overall. And in terms of fixed income, we're kind of playing it a kind of more kind of safety first approach here, being more neutral, more short dated bonds focused, as opposed to more kind of longer dated or corporate bonds or even emerging market bonds and so on as well. So we're a bit more cautious in the kind of fixed income side, based around some of these inflation concerns. Inflation still has to come down to the levels that central banks feel is optimal for them to be more comfortable dropping rates going forward. So we don't want to kind of take that risk. We'd rather take that fixed income risk or that fixed income type return from our equity book and our alternatives as well, which we have a large allocation to, and I'll touch on that in the coming slides. So moving on to, I guess, some of our portfolios. Tom's kind of touched on it at kind of high level. I just want to, without having my kind of sales lens, but just talking about it from a holistic perspective, we have a passive range. So if you want validation around our asset allocation framework and our kind of patient capital approach to investing on global equity, fixed income markets, what you can do so is take our position in our passive, which we overlay with the best passive strategies that we can find globally, physically replicated, and rebalanced every 6 months, given to advisors at a very, very efficient cost base. Some of these costs overall to an advisor would be circa 15 to about 17 bips as we speak. So very, very efficient, low cost, transparent, passive structure. And as we well know, over the last, 30 years now, passives have been taking a strong market share in any equity market, in any investment models, in any portfolio mandates. So one certainly needs to be aware of the reasons why one should be holding passives on their own, as well as potentially going on to the next slide in combination with the best of both worlds. We at Binary, we don't take a view. We understand passive, and we acknowledge it in terms of our portfolio management on the passive side. I've just touched on here. We also have a strong affiliation to understanding of genuine active portfolio management. So taking the best of both competing philosophies, I guess, somewhat, and using them in our portfolio management here. We call it a kind of three-pillar approach: fixed income, equities, and genuine liquid alternatives. And as you can see here, as an example, in our kind of balanced portfolio mandate, we don't just take a de minimis 2%, 3%, 4% position. In liquid alternatives is as high as often 20%. So you have a genuine endowment style investing model here, 50, 30, 20. And why do we do that? Firstly, we want the best of both worlds in terms of passive and an active. In our active allocation, typically we'll have large allocation to certainly weightings in some growth or core equity positions. So that can be a bit more volatile than an average equity portfolio on average. Okay, so what we do then is to mitigate some of that volatility risk or manage that, we have a strong alternative allocation around that, which means therefore we have a much more smoother ride or growth to return generation. Whereas from the upside, for as markets move up, as they typically tend to do, as I've showed you in the previous slide here, or even when we have drawdowns, as we saw in February and March and early April of this year, some of those alternative allocations will help dampen down that volatility, dampen down some of that downside risk that we may see in markets. So you get the best of everything. You get strong passive, low cost, passive, strong, the best active funds out there, and we don't believe there's many, but the best active funds out there, as well as some really credible liquid alternatives to kind of manage the risks around volatility, downside protection, and so on, without taking on, I guess, hedge fund type overlays or strategies that can be expensive and not transparent, not liquid, and so on, or expensive hedging or option-based strategies, which we don't really do whatsoever. So it can manage, become a very much a more resilient, more solid, more framework portfolio for clients that seek those steady captured returns and don't wish to take a view on either side of the active passive debate, or want the best of the blended of both worlds in that respect. Again, why liquid alternatives? I kind of touched on it again here very briefly. It's telling me, certainly in the diversification side, if you look at fixed income and equities, certainly against the S&P, over the last kind of 10, 20, 30 years, you can see the correlation is actually quite high. They're not really that well diversified over the longer term. So then why would you want to take on that allocation if it's going to mimic potentially equity allocation over the short term and long term as well? So, and the risk is often similar as well. So hence the reason we want to mitigate and move away from that at all as well. And the kind of bottom kind of Bloomberg chart, you can see again, volatility in bonds has been rising, not falling over the last few years. Many reasons we know about, obviously the rise of inflation, the rise of interest rates post-COVID and so on. And that volatility we expect, may not be as enhanced as it has been historically. As we know, it certainly will maintain a level of increase going forward as well, and something maybe we don't want to participate in because of the risks of having that. So why even go there and invest in other liquid alternatives? This chart is a classic example of what I've just said. EQR Apex over the short term, more recently, and even over the last kind of 4 or 5 years, look at the way it's performed. A very much a quant-based market falling strategy, upside as well as downside, in all markets globally, equity, commodities, fixed income, run by a very experienced investment team in the US, managing many hundreds of billions of dollars. We are very close to the team. They actually look at a lot of our processes and portfolio management as well, and have validated some of the work that we've done in the alternative space as well. So, as one example, and the other examples as well, as you can see, over the last 2-3 years, creating very steady return generation and not much vol, or certainly less vol, if I was to overlay that against other equity allocations as well there. So even against the corporate bond fund, iShares corporate bond as an example, you can see that enhanced return generation that these liquid alternatives that produce. So why would you not want to invest in them, or certainly take some sort of allocation to them? I've given you 3 examples there that we hold. There's probably 200, 300 liquid alternative choices that one can do so. So we really spend a lot of time, energy, research, and getting the best out there for the portfolio, so we can deliver the most optimal outcome for our clients, for our IFA clients, and opportunities there. Again, just kind of leading on and finally kind of finishing up, What are we seeing going forward? We kind of see more of the same, somewhat, in terms of American exceptionalism, maybe not to the same extent that we saw at the start of the year, or the narrative, but saying it's hard to argue against, certainly long term, the opportunity that America delivers in terms of returns, in terms of global economic power. The rise of AI, we think, is probably going to be underestimated long term, and the real winners in the AI race seem to be the US, Middle East, and potentially, based on what happened last week, and clearly China as well. We saw the DeepSeek announcement at the start of the year there. So certainly conviction leadership from Trump. Nobody else really is stepping up to the plate in many respects. But at the same time, there's broader economic growth coming out of Europe, finally getting its act together in terms of fiscal stimulus, defence spending as well. So perhaps from a valuation standpoint, Europe will certainly hold its own going forward as well, and come out of this kind of mirage and returns, lack of returns over the period. And that goes the same for the UK as well. We're fairly bullish on emerging markets, again, for the population growth, middle class, and valuations there as well. So certainly from us, going forward, we think volatility will probably come down. Returns, the second half should be better in terms of vol and hopefully return generation than we've seen in the first half. Interest rates will begin to trend down, albeit slowly than expected. There's a lot to still think about. This tariff cliff fall of 90 days is due to take effect later on in the summer, and fingers crossed there will be elements of pragmatism and negotiation and conclusion of deals. But who knows? We were only one tweet away from Trump saying, look, all bets are off, I'm not going to negotiate, and then we may well see another market downturn as well. So we need to be aware of that and conscious of that as well. Hence the reason we're not overweight the US. We are neutral to the US in broad economic and index terms as well. Hope that was a kind of run through of markets, some of our thinking, some of our trends. Conscious kind of had to rush through it. There's a lot to kind of take in there as well. Happy to answer questions or points where it's now later on at the end of this session, or even afterwards as well, one-to-one or collectively. What I'm going to do now is pass across to Sarb, who's now going to cover maybe some of the more detailed product areas from his and the binary perspective as well. But again, thanks for your time, for listening in, and over to you, Sarb.
Great. Thanks, Haftar. And morning, everyone. So hopefully you can hear me all right. The next part, and I'm conscious of obviously timing as well. I am keen to try and get you out for around 11:45-ish as well. I think the last part, just a couple of slides that I had, was to talk a bit more around binary and one of the research papers that we sort of did earlier this year, and sort of back end of last year, which was more around IFA insights. You've seen some of the performance and the way that we handle markets from Safra and Tom. I think we also are very cognizant of how we work and deal with the business side of this kind of partnership. So Safra, if you can go just next slide, please. Perfect. So I think the key thing on this slide that I wanted to get across, one of the first questions we asked is we took price and performance away from advisors and asked what was it that was driving their decision making when it comes to an MPS provider. I think price and performance from a quant basis, and again, Tom mentioned some of those, FE and Mabel, etc. I think they're always going to be a determinating factor, but we were very conscious of what actually sits as the top of their sort of mindset outside of that, and we envisioned that was going to be around service and proposition and partnership, as we expect, which you can obviously see is one of the higher ranking responses. But the highest ranked one, and again, bear in mind this was taken in sort of back end of October, November time when we did this, so not exactly in the sort of the volatility period that we saw earlier this year. It was actually ease of doing business with us as a DFM was quite important, and also responsiveness. Now that surprised us a little bit in some ways, because actually at the back end of last year, a lot of firms weren't really looking for much contact. Things were going quite well generally in the markets. There's a bit of a boost post sort of Trump coming in his election. So we were quite taken back a bit, but I think that's an important point of what we're then trying to do as a DFM and a business partner going forward. So we've taken that on board, but I think that was a very interesting piece that came across from us. Thanks, After. If you go just next slide. So what we did, and as part of the sort of question set, is we have anonymized all of this, but there was dozens of firms that took part, and we took certain bits of their information, and we thought, right, if we've got that question set on one side, what can we actually see from their pain points that you're looking for? And again, interestingly enough, the top pain point was again a communication and responsiveness. So what we've tried to do here at Binary, and I've got a slide later on that talks about this, is right, how would we sort of fix that sort of problem from our perspective? I mean, there's only so much we can control, but how can we make sure that you've got accessibility to us as a team? You know, we're going to be there for the harder decisions, especially with the more volatility we're going to see in marketplaces. The other point was about limited differential, and I think this is a really interesting point because price and performance you've seen, again, I've mentioned it slightly before, but if you take price and performance away, what differentiates one DFM to another? And I think from our perspective, we're always going to be cognizant that we want to showcase everything from partnership, accessibility to the investment team, the fact that you can pick up the phone and actually speak to someone, be it myself, be it to our head of client service, or even if it is someone like Safdar. And we did a lot of that, and there was a lot of commentary going out around the tariffs. A lot of firms are approaching us for certain types of questions. And what we did is, and obviously as businesses, we answered those questions to the IFA, and then we actually posted something like an article link into that. And we were sort of doing, you know, almost one or two posts a day for a matter of weeks as things were sort of progressing in the markets. So I think that kind of responsiveness is what we're now trying to take away as a business, and that's one of our sort of key differentials that we're trying to portray. The last point I won't mention too much, but that inflexibility in portfolio customization that we saw there, that was very much, and we did ask a few IFAs to explain that, and that was very much down to the sort of bespoke mandates. And it's not something that we're big on. I think a lot of the traditional DFMs are very big on sort of those bespoke mandates. We very much stick to the MPS landscape, but it does seem that there are still some firms that do require that in their portfolios. On the right-hand side was very much from our partner firms, where we asked them, again, all anonymized, but we asked them, you know, what was their perception on us. I won't go through all of them. You will get the slides at the end. But the three that I wanted to mention is, you know, again, that direct access, you know, how can we have that personal relationship? And I think we're very aware that this is a business as a DFM speaking to either business owners, you know, employed people in business or decision makers in business. So I think we're trying to take away from the fact that this isn't a IFA and a service provider. How can we help you in a business perspective? So that direct decision maker access that we give you is something that we're trying to produce of value. The next part of it that I wanted to mention obviously was the price. Sorry, Safdar, if you go back to the previous slide just quickly, was the price part of it. Now, price is never going to stay competitive for long, I always see. I mean, I've been in the MPS landscape for the past sort of 6-7 years, and I've seen that price come down massively now. We're at the moment on the forefront of that, around 5 basis points, but I wouldn't say that that's always going to be the lowest. There will probably someone come out at 3 basis points, and someone might offer it for free for whatever various reason. So we're never going to stick our hat on the price is the most important part, but it does play a factor. So I think being competitive in that landscape is quite important. The last one on this point was the transparency and open communication at the bottom. I think that's just, again, linking through to being able to get an answer from us, whether it's a query on platforms, whether it's a query on another part of your business, you know, you want access to some of that intellectual property, or whether it is just a market update. You know, you've got a client review coming up and you want to get some answers before that meeting. I think getting those is quite important. So we are taking some of those points away, and luckily our partner firms are saying likewise. Thanks, Safdar. If you go just next slide, I will just run through the next two quite quickly. I won't mention the things on the right-hand side. I think Safdar and Tom have sort of talked about the investment strategy and the service, but I think the important thing, and Tom mentioned it earlier, is we don't compete with you as IFAs. I mean, at the end of the day, we're an MPS provider. We know our space relatively well, but we don't know the IFA landscape. You know, we can't do your day job as it is. So we understand that we're not going to compete with you. We don't own any IFAs. We don't have a D2C proposition. We're just trying to offer a good, strong strategy and proposition on our side of things. And hopefully we're doing a good job on that. And then the business partnership, again, I know I've sort of alluded to this, but it goes to that tagline you can see there, what we do takes two. We understand that as business owners, your need isn't just what's the best investment proposition. When we talk about that DFM differential, a lot of them will offer good returns. I mean, we should all be offering good returns. And if they're not, please do speak to us. But I think if we're all offering great returns and we've been competitive on price, it's how do we differentiate? And from our perspective, when we say partnership, we do go ahead and mean it. I mean, we're talking about if you need support on power planning, right? We've got businesses who we know are great at doing that, and we will just refer you on. We don't get any referral fee. It's just part of our ecosystem, and we're just getting you access to that. If you need funding for an MBO, or if you're looking to speak to consolidators, if you're looking to speak to tech firms, AI is a big thing right now. we have relationships there where we can actually refer our clients to make sure that they're getting the right value. And we'd like to become that sort of trusted conduit and almost like an extension of our advisors' businesses. Now, that does mean we can't work with every IFA firm that we ever come across, because that does diminish the accessibility that I've just spoken about. But the partner firms that we do have, I mean, as much trust and value they have in us, we sort of show likewise. Thanks, Safta. Just next slide quickly. This is the hyper-personalization. I think I've created this slide based on some of the IFA insights that we had through. Luckily, we already had some of this in place, but I think the reason why we want to show this in terms of the support we give advisors, it's not just the fact sheets that we give on a monthly basis or the monthly performance updates. I mean, there's a market update that comes from Safta, every month. There's a quarterly updates that you can give your clients, but on the other side of things, it's consumer duty documents. It's reasons why, all the things that fit into your suitability. We're very much aware of those, and we're trying to stay on top of that. So these can all be white labeled. You're going to change the color, the font. You're going to make it very personable to yourself. So we're giving you that personalization that you can then pass on to your clients in some way. Thank you, Safta. And just next slide. And this is the final one. Before we I've seen a couple of questions come through the Q&A, but if there is anyone who's just looking to ask one, if you click the tab at the top on the Q&A, you can ask anonymously if you want. I've seen one go in for that today. But yeah, do ask the questions as we just finish off. But on this slide, I just wanted to highlight the roadshow we've got going. I mean, we're not going to cover off similar topics like we've spoken about today. I think we've got two in particular dates. One is London centric, so that's our sort of summer drinks that we're having with alongside Fundment. We will have them present on the platform space, which they've been quite successful on, and then we'll be talking more predominantly on the alternative side, as Safta mentioned. It's not just endowment funds and pension funds. A lot of institutional investors are now looking at alternatives. So I think both from an accumulation perspective, but also particularly a decumulation perspective, that's playing a higher role. And I think we need to sort of have that open discussion with IFA. So that's what we're doing on this roadshow. But on the right hand side, Tom did mention Mabel. So if you did want to see them and you're in any of those locations, throughout June, Cheltenham, East Midlands, Newcastle, we will be there with Mabel, they'll be revealing their tech side of things. And again, we'll be having that discussion on alternatives and decumulation. So that's everything from the webinar. Thanks, Safta. That's me. So I'm happy to stop at any sort of questions. Again, I've gone a couple of minutes over, so I'm keen to answer any sort of questions before we stop completely. You will get the slides, and if you do want some CPD, please contact me and Tom. We can obviously arrange CPD for that. There is one question that has come through, so if there is no more, we will end at that one. But if there is anyone else who's got any other questions, please add it into the chat. Safta, it's one for you that was asked, I think, earlier on in the presentation. It was, I think, one of your slides that talked about sort of drawdown. So one of the questions is, do we expect similar drawdown like what we've seen earlier in this year? So I think this is more of a question of, do we think that what's happened, and based on some of the things you've said, do we think that can happen again in the next sort of 6 months?
Yeah, thanks, Sarb. Yeah, what I would say there is, do we expect a drawdown similar to this year or whatever? The simple answer is I don't know. Nobody knows. Obviously, we saw a strong drawdown as we've seen this year by 20%. Market and correction territory, certainly the US market, and then recovering quite a bit. As I said, to the extent that the Nasdaq, the tech-heavy Nasdaq index, which we know a lot, is only down 4% off its all-time high. One can argue that's the bullish sentiment has moved too much in that dial. So there's bound to be elements of cooling off. Because going back to the point that I made earlier, US equities are still very highly valued. And if you believe that tariffs will settle at, see this 10% tariff structure, base case number, and if you believe that Trump wants to definitely do more onshoring in the US, that is bound to increase costs, is bound to affect margins for many companies. We saw even this week, I think it was Costco and Walmart saying they may have to increase prices to offset the cost base. So that's bound to drop profits. I saw somebody saying, 2 weeks ago, Apple has 40% margins. There's no reason why those margins may not have to come down to closer to 20%, and therefore there's going to be a corresponding valuation realignment there. So there may well be further volatility, further drawdowns in the equity market, specifically the US. But in saying that, because we're long-term investors, often we don't mind this volatility or this drawdown because we want to manage through that. And long-term, we're fairly bullish on the US being the center of gravity for growth, economic development, and globalization growth, AI, and all the implications for that, whether it's in the tech sector or more broadly in healthcare, pharmaceutical, consumer services, and whatever. So I'm fairly cautious. I'm quite cautious going forward, but more positive long term, and hence the reason we're managing our portfolios in that kind of cautious manner, certainly in our kind of core strategies anyway, is the point I would make. I do not see another 20% drawdown for in the second half of this year, but there may well be pockets of smaller drawdowns in that point.
Perfect. Thanks, After. Just in essence of timing, we will stop it there. Thank you everyone for joining, and hope you've enjoyed it, and hope to see you next time.